Hey guys, welcome back. Well, I don't have to tell you how painful of a week this was, because if you look at the memory sector, if you look at the memory titans or the Fab Four that we like to call them, or maybe the Fab Five now, they certainly didn't feel that fabulous this week. We don't have to look at a sea of red numbers to understand the pain that we're all feeling in this sector right now. We saw Micron drop down to an intraday low of $804 a share on Friday, just before institutional accumulation stepped in, reversing nearly $55 to close at $849 on Friday. But SanDisk was down by 29% this week. We saw SK Hynix lose 20% of its market capitalization in a week. Kioxia was down by 16% on Friday. Samsung lost 12% across the week. And the Philadelphia Semiconductor Index was down by 8.5% this week. So I say all that just to share with you that the pain was evident across the entire sector overall this week. We've officially entered a technical bear market because we're down 24% since the peak of these stocks in June, right about mid-June. I don't think that the selling is telling us that demand is collapsing. I think it is telling us that Wall Street has changed what it's looking for. For the last 2 years, Wall Street has rewarded companies for simply selling more AI hardware. Today, the market started asking a different question. It started asking, what happens if AI spending is still enormous, but it is no longer accelerating at the rate we're seeing today? I believe we are witnessing right now a profound structural repricing, a quiet rotation out of a crowded infrastructure trade that I call the Underhood Shift. Today, we're going to look at the technical pattern for Micron across the entire week. And we'll also look at what its history tells us when the stock has dropped more than 20% in the past. We'll dissect what exactly is changing beneath the headlines and why Wall Street is quietly repricing. And I want to give you a few capital protection strategies at the end of the video. So make sure you stay to the end, because I have 3 clear strategies that you may want to deploy if you're feeling anxiety and want to preserve your capital right now. But before we get into the data, guys, make sure you hit like, make sure you subscribe to the channel. We're going to cover a lot of great details in this video, so make sure you stay for the whole video, and make sure you stay to the end to get those strategies overall. But if you haven't done it yet, make sure you subscribe as well. Let's get started with the video. So let's start off by taking a look at some of the headlines this week, just to understand the sentiment overall. Here's Market Watch. You can see on the left, Dow, S&P 500, and NASDAQ suffer weekly losses as chip stocks enter bear market. You can just see the impact of the stocks there, that orange line dropping down compared to the Dow Jones Industrial Average and compared to the other indexes as well. But I want to call out this article here, 19 tech stocks that have fallen at least 25% in July. These are many of the names that we talk about in the channel, just so you can understand where exactly this is hitting across the entire AI hardware, across the tech sector overall. But you can see SanDisk leading the way. July price change is down 40%. Corning, right there. Corning's been a high flyer with all of its optical, kind of push into optical and the momentum it's had there. It's down almost 40% as well. Astera Labs, 37% down. Marvell, Nebius, Rocket, Teradyne, Intel. If you scroll down further, you can see KLA, Lam. There's Coherent, another optical player. Applied Materials. So you're getting the picks and the shovels affected as well. Micron down here, 26.5% affected in July. CoreWeave down, Credo, Western Digital. The list can go on and on. These are all the names that you know that we track on the channel. But as I pull over another article, this is from Brittany Wynn, basically highlighting some comments from the analysts from Bank of America that says chip stocks have entered a bear market, but Bank of America analyst says not to panic. And let me show you why, what his sentiment was. All highlighted right here. He calls out Micron, SanDisk, Western Digital, and Seagate, and the impact on their stocks and what we've seen not only on Friday, but we've seen across the week. And goes on to further say that spending on memory chips now account for 35 to 40% of the hyperscaler capital expenditures. I want you to remember that number, because I'm going to get to it in a little bit in the video, the importance of that as well. But he says that Arias says that this is 2 to 3 times higher than it has been historically. He expects, though, both spot and contract pricing for memory components to remain durable in the current quarter, and noted that spot prices for DRAM have climbed for 8 straight weeks, while pricing NAND flash memory has also been stronger. Vivek also goes on to say that improved visibility into the multi-year cycle for AI infrastructure supports his expectations for wafer fab equipment to reach, and we know this, right? The TAM for wafer fab equipment is projected to go from 190 billion to 250 billion in 2028. He also mentions there's some other clear signals for the sector that Taiwan Semiconductor has raised its U.S. investment to 265 billion. In his opinion, this could further pressure Intel and Samsung to increase their spending as well, their U.S. spending as well. He claims also, or he mentions also, that ASML's guidance for shipments of its deep ultraviolet lithography and extreme ultraviolet lithography machines, they're going to grow by 30% annually in 2027 and 2028, along with anticipation of price hikes for those products. So those all provide a tailwind for the broader semiconductor sector, according to this Bank of America analyst. So as I mentioned in the beginning, he says we are in a bear market, but not to panic as for us as investors. But let's jump over and take a look at Micron. This is their technical pattern for the week. It's in a 15-minute candle pattern that you can see, and you clearly see a head and shoulders pattern. If you look at it here, starting on Monday, which would be, you see the drop off from Friday to the start of the week, Monday. We had a gap down, as we all know. That is the start of the head and shoulders kind of pattern. It's a classic bearish reversal pattern that signals a shifting regime from institutional accumulation to distribution. That's what this week tells us overall. This indicates that sellers have firmly seized short-term control of the stock. For Micron investors, this pattern warns of immediate downside risks and suggests that previous upward momentum has definitely stalled at the moment. Long-term shareholders holding out for higher structural price targets may need to weather short-term volatility, right? But I want to jump in and just show you, in the past, Micron has had 4 major drawdowns, and I had this graphic created for we can look at it together. These are drawdowns over 20%. If we go back to the 2022 semiconductor bear market, you see that Micron, and these prices are wild if we just think how quickly this stock has grown. Micron hit a peak on January of 2022 of $97 a share, and it dropped by almost 50%, 48.7%, down. It reached its low in December of that year of about $50 a share. This was a post-pandemic global oversupply of memory chips combined with aggressive Fed interest rate hikes. The duration, you can see, it was 11 months that it took to get to the bottom, from January to December. To stabilize, it took 4 months to stabilize, so we had some sideways action between that 50 and 60, and then 15 months to reclaim the prior peak. It got back up to that $97 range in March of 24. Now, if we go into the mid-2023 range, you can see there was a drop there as well at a 25.7 decline. The catalyst here was lingering weakness in DRAM and NAND average selling prices. The duration here was about 2 months. It took 2 months to get to the bottom from May to July. It was an immediate stabilization right here after it hit the low of 60 in July, and it 4 months to reclaim that peak of $74 a share. If we go over to 2024, this is the global market shocks where the stock was at $134 a share. It dropped down to $91 a share, a 32% decline. This was driven by broad technology sector de-risking, triggered by the global yen carry trade unwind and the macroeconomic growth fears. Definitely remember this drop with Micron as well. And this took 2 months to get to the bottom. It took 3 months to stabilize, where it stayed between $90 and $105 a share, and 8 months to reclaim the prior peak. It was March of 2025 where it reached that high. And then finally, we had the current drawdown that we're in right now, where Micron hit a high of just over $1,200 a share, and currently we're at $848 a share, a 30% decline. This catalyst is market anxiety over peak cycle profits, competitive supply pressure from Samsung, SK Hynix, probably put in the Chinese providers as well, CXMT in there, and high insider selling. So not a major catalyst like you see in the others, but this is the catalyst that's driving the sentiment right now. The duration to the bottom is obviously, it's ongoing right now. We'll see when we get to the bottom. We haven't stabilized yet, and it'll be to be determined when we'll be able to reach or reclaim the prior peak. But the bottom line, you can see below, the key takeaway is that Micron has experienced 4 greater than 20% drawdowns in the past 5 years, each driven by different macro catalysts. Drawdowns are part of the cycle, but history shows consistent recoveries and new highs over time. And the other one I want to call out, which wasn't included, was the March of this year, the earnings, because it didn't get over 20%. It was right at 20%. But this also was a drop. If you remember, we were at a peak price on March 19th of $4.44 a share. We hit the bottom on March 27th of $3.55 a share, 20% drop. It took 1 week to stabilize in that drawdown and 3 weeks to reclaim. On April 17th, the stock climbed back to $4.55, fully erasing the earnings losses. And we know it didn't stop there. You can see the expansion. The rapid stabilization launched Micron into the most explosive rally of the year, capitulating the stock past 740 by early May and eventually crossing the 1100 line in late June overall. So those are the things I just wanted to share some of those with you guys, because that's what we're in right now. That's the sector or the segment we're in, the sentiment we're in right now. That's what we're feeling. And I think the biggest piece we have to look at is what is causing the drawdown, or what are some of the bearish narratives that could cause further drawdown. To understand why this is happening, you have to look at the primary buyers for AI hardware, the hyperscalers. Because for the past 2 years, Wall Street has operated under a single assumption that these tech giants would accelerate capital expenditures exponentially forever. And that takes us to the first layer of the Underhood Shift, because big tech spending isn't slowing down, but the rate of acceleration or the acceleration of that spending very well may be slowing down. And there's some reasons for that. So let's jump into the article that covers this specifically from investing.com. You can see the article. Among the AI crowd, some investors position for slower hyperscaler spending growth. It all comes down to a report by UBS here in the second paragraph highlighted. They are saying that spending looks set to slow. UBS estimates that hyperscaler capex will rise 76% this year to $673 billion, but will increase only 25% next year and just 6% in 2028. Now, the first thing I have to call out is a 25% increase on top of the spending that we have seen this year of $673 billion. Some estimated even to be higher. 25% on top of that is still a significant investment into the build out. We cannot forget that piece overall. But the acceleration, according to UBS, does seem to be slowing down. I don't know if it could have stayed on the pace that we're looking at right now, but this is causing some anxiety and some fear to investors overall. They go on to say that once the spending increases, once they stop increasing their capex, it'll definitely be a relief for the hyperscalers and their balance sheets, and it'll be a negative signal for the semiconductor industry. As we go on further, there's another factor in here that I want to call out. I've seen this also from some other analysts, but they're mentioning that in the beginning, hyperscalers, they funded the initial AI build out through their own cash, but now they are increasingly turning to external financing, which is prompting questions over whether capital markets and the pressure that they'll receive from capital markets will eventually constrain the spending growth as well. So it's another factor to break in. Will the external financing give the same level of capital to the hyperscalers that they want, or will that also put a constraint and slow down the acceleration that UBS is saying in the beginning? Because cash flow right now is starting to become completely drained by capex. And it's arguing that they argue that hyperscalers will become more disciplined on their spending growth overall. But against that backdrop, there's some things I want to point out from empirical research here. They highlight that a growing mismatch between moderating capex growth and lofty revenue expectations for chip makers and other suppliers of the AI infrastructure, they imply that something has to give. Either the capex trajectory or the hyperscalers will be upgraded again, or the revenue growth penciled in for their suppliers will come from somewhere else. Madeline Ronner with DWS goes on to say she expects earnings season commentary from hyperscalers, which is next week, guys, over the next 2 weeks. She expects it to remain supportive of further investment. So I don't think we'll hear from the hyperscalers that they're slowing down, which would definitely drive the stocks down further. It would be a negative signal overall for the sector. But there's another layer that I want to call out, which is also slowing down the growth of data centers. This is the second layer of the Underhood Shift. And it's all around kind of the pushback or the opposition that they're seeing right now. AI hardware has officially kind of collided with the physical reality of power, water, land, and permits. Just this week, New York became the first state in the nation to enact a full statewide one-year moratorium on the construction of large data centers, utilizing 50 megawatts of power or more. The governor signed an executive order order to halt permitting because facilities are threatening to overload the local utility grid and drain water tables for cooling. Now, empirical research also mentions, you can see in the paragraph above there, that nearly 70% of proposed data center projects across the U.S. are currently facing some degree of local community or regulatory pushback. The physical world has put a hard ceiling on the exponential growth that we want to see with data centers. Now, it's put it on in New York, but remember, on the flip side of that, there are many states like Arizona, Texas, and others that are very pro build out of data centers. So we may see a shift from these companies to start to build and start to move some of their projects into states that are deemed more business friendly and less regulatory concerns or opposition that they may be facing in other areas. This is where the entire Underhood shift comes into full view, in my opinion, because how do we weigh the obvious near-term bear cases that we see right now with the structural bull realities of the AI infrastructure build out? We know that institutional investing is all about probability and evidence. So let's look at the data objectively. The first thing I want to call out is the mathematical valuation reset, because a comprehensive data report from Morningstar highlighted that due to Micron's drop of 30% that we've seen since its peak in June, right now we are seeing its forward PE at an absurd level, an absurdly cheap level. You can see on the screen, forward PE from Micron. I'm going to circle it. Where is it? Forward PE right here. Sorry, 5.5x. It's an absurd cheap level for the stock. So this means despite the dropping price, the stock has never fundamentally been cheaper. And second, there is a massive mismatch right now between sell-side analyst modeling and buy-side reality. The asset managers at DWS pointed out that internal buy-side forecasts for 2027 tech spending remain materially higher than Wall Street's consensus. And this is because we know that every hyperscaler has facing the same issue right now, the same problem. If one company slows AI spending while everyone else keeps investing, it risks falling permanently behind. That's why buy-side investors believe that the AI capex will remain much higher than Wall Street currently expects. If one player trims its AI budget, their rivals will instantly leapfrog them. The fear of missing the paradigm shift completely eclipses the fear of overspending. And finally, the memory demand is decoupling from the legacy commodity cycle. We have talked about it on the channel, how the rapid industry trend that's happening right now, moving from AI training to AI inference, it is generating a compounding data explosion. Zacks research highlighted that enterprise flash and high bandwidth solutions are facing a 25% CAGR. UBS forecasts that DRAM will remain systematically undersupplied until the second quarter of 2028. Hyperscalers cannot stop buying memory if they want to stay in this race. So how do you handle this volatility as an investor, the volatility we're seeing in the market right now? Because if you're holding core positions in companies like Micron, SanDisk, Western Digital, and Seagate, you do not have to choose between panic selling and sitting there defenseless, blindly riding out a violent flush. You can utilize the exact capital protection tools that are leveraged by institutional desks. Let me pull up a picture that I created. We can walk through 3 scenarios that you could potentially choose if you think it fits your portfolio overall. The first one you can see on your screen, or I'll say across the top, 3 capital protection tools, institutional playbooks to protect capital and stay in the game. The first one on the left is the zero cost collar. If you own the underlying stock and want a guaranteed floor, you buy an out-of-money protective put option to limit your absolute downside. At the same time, though, you sell an out-of-money call option against your shares. The premium you collect from selling that call fully pays for the protective put. Your downside is mathematically capped, and your capital is safe, with the only trade-off being that your upside is temporarily limited to your call strike price if the market violently snaps back. The second is shaving leverage. Playbook number 2 in the middle. The biggest risk in a technical flush isn't the underlying business. It's option premium decay and leverage ETF rebalancing mechanics. And we've seen that in the memory sector right now. If you are holding 2x or 3x long instruments or short-dated options, you are fighting mathematical gravity during a sector rotation. Consider cutting leverage exposure entirely and rotating that capital back into the under-leveraged common equity. Holding the actual stock allows you to comfortably outlast the daily noise. And then third, probably my recommendation for most on the channel would be a tranche-based accumulation. If you have cash on the sideline, do not throw it all into the market on a single green day. Divide your dry powder into 3 or 4 equal parts. Deploy a single tranche now that valuations have compressed to single-digit forward multiples like we just saw with Micron. And keep your remaining tranches in reserves to accumulate further down if the market if it continues to test major long-term moving averages. So guys, those are 3 clear techniques that you could use. Take a picture of it, keep it for yourself, and review it as well. Those are clear techniques that you could use to preserve some capital overall. But guys, in closing, the headlines this week told us that AI demand may be collapsing. The data told us a completely different story, though. The market isn't debating whether AI wins anymore. It's debating how long extraordinary profits last in this sector. And that's a much better problem to have for us as investors. So until the data changes completely, until I see signals that are showing me something else, that's the conversation that I'm going to follow on this channel, the conversation that I'm going to share with each and every one of you guys. Hope you enjoyed the video. Share your comments below. Let me know your thoughts, and I'll see you on the next one.